Meta just dropped their MetaConnect 2025 keynote, but instead of applause, much of it felt more like cringing. Between messy demos, underwhelming Ray-Ban smart glasses display, and Zuckerberg leaning hard towards youth strategy, questions are flying like, can Meta turn all of this into real money? Or is it betting on trends that won't pay off for investors? Hello and welcome back to Today in Finance, your go-to channel for breaking down big tech moves in simple finance terms. Today we're diving into the MetaConnect 2025, what went wrong with the new Ray-Ban display, and how Mark Zuckerberg's push towards younger users can affect Meta's bottom line, both opportunities and risks. So without further ado, let's get right into today's video. MetaConnect is the company's big yearly event where they reveal their vision for augmented, virtual, and mixed reality. Think of it as Meta's version of Apple's iPhone launch event, which by the way, I've made a detailed video on, so make sure to check that out as well if you haven't already. Coming back to Meta. This year, the timing was a little bit strange for Meta because they held it just days after the Apple's big iPhone launch event, which risked being drowned out in the news cycle. Even worse, the keynote ran at 8 p.m. Eastern in the US. That's late, meaning fewer eyeballs live. And to top it off, some demos didn't go smoothly either. That's exactly the opposite of what you want when you're trying to prove that your product is futuristic. So right out of the gate, Meta was fighting an uphill battle. Now let's finally talk about the much hyped product review, the Ray-Ban Digital Smart Glasses. On paper, it does sound cool. Glasses that gives you notifications, maps, and AR features right in front of your eyes. Sounds cool, right? But here's the catch. The reality didn't live up to the promise. Here are the biggest problems. Display quality isn't there yet. The screen built into the glasses just doesn't feel advanced enough. The resolution and brightness can't compete with what people are used to on their phones. In real-world use, like outdoors in sunlight, it feels more like a downgrade than an upgrade. That kills the wow factor that Meta desperately needs. Use cases are too thin. Okay, so you can get messages, whether updates or directions in your glasses, but let's be real. Your phone already does all that and more with a much better display. Unless these glasses bring something totally new to the table, most people will ask, why bother? Price versus value doesn't match. These aren't going to be cheap, and if people feel like they're paying premium money for a gadget that's less useful than their phone, adoption is going to be slow. For investors, this means lots of money spent on hardware development, but not much revenue coming back. Bad timing and bad demos. By launching right after Apple's big event, Meta basically set itself up to be overshadowed. Add in those live demo hiccups, and the glasses came off as half-finished. First impressions truly matter, especially in tech, and this one wasn't strong enough. At MetaConnect 2025, Mark Zuckerberg doubled down on one big idea. The future of Meta is in the hands of young users. The thinking here is pretty straightforward because young people are usually the first ones to try on new gadgets, platforms, and apps. They're more willing to try things like AR and VR, and if Meta can win them over early, it would definitely build loyalty that could last for decades. In other words, today's teenagers are tomorrow's lifelong Meta customers. Now let's connect all of this to real money, because at the end of the day, investors don't really care about cool demos. The only thing that they care about is profits. So here are the key financial angles. Revenue versus costs. Hardware like smart glasses is super expensive to build. Meta is already spending billions on R&D, manufacturing, and marketing. If revenue from these glasses doesn't take off quickly, those costs will weigh down profits. Margin pressure. Unlike software, where margins are sky high, hardware margins are slim. The Ray-Ban display is unlikely to be profitable at first, Unless Meta can sell millions of units, the hardware business could drag down the company's overall margins. Monetization of younger users. If Meta is betting on youth, they need to figure out how to make money from them. Ads, in-app purchases, AR experiences, these all take time to scale. Until then, the youth strategy might just mean high expenses with little return. Competitive threats. Apple is the elephant in the room. If Apple releases a polished version of smart glasses, Meta could instantly lose market share. And once Apple steps in, they usually dominate with branding and ecosystem. Investors already know this, which is why Meta stock could take a hit if Apple enters with a better product. Stock market risks. If Meta promises big growth from these initiatives but can't deliver, the stock will definitely suffer. Tech investors hate when forecasts don't match reality. On the flip side, if adoption surprises to the upside, the stock could rally. It all depends on execution. Here's the big picture. Meta Connect 2025 did show ambition, but its execution is still shaky. The Ray-Ban display isn't ready for the mainstream, and Zuckerberg's youth strategy is a long-term bet with short-term costs. So for investors, the real big question is, will Meta eventually crack the code on AR glasses and youth monetization? If yes, the payoff could be massive. But if not, we'll be looking at years of heavy spending with just a little return. So yes, the future of Meta and its stock will stay volatile, at least for a short period of time. So, what do you think? Would you actually wear Ray-Ban smart glasses with a tiny screen? Or are you sticking with your phone? Drop your thoughts in the comments down below. Also, if you found this video helpful, hit that like button and subscribe to my channel for more financial insights. Thanks for watching.